leave this open for a couple more minutes. in
Yeah,
case-
please do.
Okay.
Okay. My name is Michael Ince. I'm a lawyer that does estate planning. My practice is concentrated in estate planning, succession planning, and I do investment planning. Okay? And that's what we do. I have a couple lawyers in my firm that do a little bit of like litigation, that sort of thing, but typically estate planning is what we do. Hopefully each of you have a survey, and the main thing I want you to put your hands on are these slides. Okay, and that's where we're going to start. Everybody have a pen? Did you need a pen? I found one.
Oh, good, I need that.
Okay, everybody got a pen, everybody's got their slides. So here we go. Basically, and I'm going to have to use this stool. I'm sorry, but I've got knee surgery coming up in July. Okay. When we talk about estate planning, we have, it's so mushy and so comprehensive that we have to categorize it so that we can understand it. And that is the point of this. Today, we're trying to get you in the ballpark and at least help you identify what you need to worry about or what you find out more about, okay? Okay. Estate planning can be divided up into 4 categories: intangible costs, transfer costs, tax costs, and asset protection. Okay? And each of those themes is something we consider in a good estate plan. Now, under the heading of tangible costs, that's things like we can't put a dollar value on. Like if you had an incapacitated child that you need to make provisions for, or you had a sorry son-in-law you wanted to make sure stayed out of the money. Or perhaps your intangible issue is how do we successfully transition this business to the next generation. So again, non-dollar things that we have to think about and we want to take care of. Is your spouse a second spouse? So that we have to make some special arrangements to make sure they're taken care of, but the assets ultimately go to the children of the first marriage. That's an intangible cost. The next one then is, and that's really probably all we're going to say about that intangible cost because it's so person specific. Your intangible cost will not be anywhere near, or will probably not be similar to someone else's. Okay. So that's intangible cost. Now we go to transfer cost. Transfer costs are what you pay the lawyers in the courts to transfer the title of your assets to the next generation. That's what this is all about. We want whoever our heirs are to have clear, marketable title to the property. Okay? Now, to do that, there are only 3 ways that you can get there from here. At your death, everything you own is going to pass by one of these 3 ways to the next generation. It's either going to pass by operation of law, it's going to go through a trust, or it's going to go through probate. Okay? Now, things come out of your estate in this order. That's a key thing to remember. If I was in my notes, I'd write on there, comes out in this order. Because what happens is, and we'll get to a second, well, let's just start at the beginning. Operational law are things like joint tenancy with rights of survivorship, things that are life estate, remainder interest, things that are a POD, pay on death, like a IRA beneficiary is an operational law item. Death benefit from a life insurance is an operational law item. Okay? Then the next thing is a trust. A trust can only control what's in it though. So if you set up a trust as part of your estate plan, it's important that you fund that trust with your assets. And with real property or minerals, you simply do that with a simple deed. And on your bank accounts, all you do is just change the name over to your trust. Okay? So once you get kind of used to it, honestly, it's kind of like when you got married, for those of you that have been married and you changed your name. It's that same sort of process. Once you get used to having the trust, it's just no big deal. Okay? Because you know how it works. Okay. Then lastly, the catch-all is probate. If you've done nothing else or it doesn't pass by one of those 2 ways, it goes through probate. Probate is simply the judicial process by where we identify your assets, we identify who you owe money to, we identify who's supposed to get your property, we cancel out your creditors, and we give it to those people. Unfortunately, that process takes almost a year to get through. That's why most of my clients elect for their estate to pass by one or two or a combination of one and two. Okay, because we want to avoid probate typically. But probate doesn't have to be the death knell, you know what I mean? If your attorney knows what they're doing and they're going to push it, they can get a probate done. Okay, 3 ways to transfer your property: operation of law, trust, probate. Everybody in the boat? Let's go to the next one. Now, we talked about intangible cost, we've talked about transfer cost, and now we're going to talk about tax cost. Tax costs are imposed. There are several different taxes we worry about. We worry about estate tax, which is a tax on property you give away after you die. We worry about gift tax, which is a tax on property you give away before you die. You know what income tax is, or at least I hope you do. And then capital gains tax is a tax on the sale of a capital piece of property, a long-term or short-term piece of property, right? It's not earned income. It's subject to capital gains tax. And then lastly is generation skipping tax. We're not going to say much about generation skipping tax today because it so rarely applies. But know that generation skipping tax is a tax that applies in addition to all other taxes on property you pass to persons who are 2 or more generations below you, like your grandkids. Okay? That's the bad news. The good news is there's a $12 million exemption. So until your gifts to your grandkids exceed $12 million, you don't have to worry about it. Now, if you tie that money up in trust and it grows to more than $12 million, you might have a problem. So if you're leaving large amounts of cash to your kids, just know you got to talk to someone about generation skipping tax and get past that if you're giving it to grandkids. I'm talking in the million or more range. Okay? Okay. Estate tax, tax on property you give away after you die. Gift tax, tax on property you give away before you die. Income tax, you know the others. Generation skipping tax, we're not going to say any more about it. Just know that it is out there. Again, under the heading of tax cost, this is a simplified taxing formula, and I'm sure it horrifies any accountant sitting in the audience. But we have to simplify it so that it makes some sense. And basically what we're going to do is we're going to take your gross estate, which is the fair market value of anything you have incidents of ownership in. What do you want me to do? Slow down?
No, you're fine, you're fine.
Incidents of ownership is broader than mere ownership. So if I owned a apartment complex and 10 years ago I deeded it to my child, but I saved 10% of the income, then at my death, the entire value of that apartment complex on the date of my death, not the date of the gift, would be included and taxed in my estate because I at one time owned all of that asset and I retained an incident of ownership, and that makes it includable under, I think it's 2036, section 2036. But anyway, it's includable in your estate. You with me? So you got to be careful about that. What's in your estate? Okay, so we take the fair market value of everything you have in incidents of ownership, we subtract off your debts to get your net estate, then we subtract the deduction provided by the law. There's only 2 that we really care about. One is the unlimited marital deduction, and the second one is the unlimited charitable deduction. Now, if you study this subject, I think it was in like 83, the marital deduction was limited to like $300,000. So you can only give your spouse $300,000. That is now an unlimited deduction. So to be clear, if you have a $5 billion estate and you leave it to your spouse, your estate will pay no estate tax because of the unlimited marital deduction. If you leave your estate to a 501c3 charity and it's $5 billion, you will pay no estate tax because of the unlimited charitable deduction that's only available at your death. During your life, if you make a charitable deduction, it's subject to certain income or deduction limits. Like, I think it's 30% if it's adjusted, referencing appreciated property, that sort of thing. So remember, this is for estate tax we're talking about. Unlimited charitable deduction is only as it relates to an estate tax issue, not income tax. Okay. Gross estate minus liabilities equals net estate minus deductions equal taxable estate times the rate table equals the attending tax minus any credits provided by the law. This credit for state dex taxes we really don't care about because it's such a minor thing. But this unified credit, this is the big daddy that I want you to pay attention to. Okay? Now, unless you had the tax table memorized, the unified credit amount isn't going to mean anything to you. So what we're going to talk about today is an exemption amount. Okay? The exemption amount is the value of the property that the unified credit will cover. Okay? Today, that number is 12.92 million. So if you died today, you would not pay any estate tax if you gave your property to me, which is always a good idea, by the way, unless your estate was over $12.92 million. You with me on this? So, you talk about death taxes, estate taxes. It's not an issue unless your estate's over this much. Okay? It's just not an issue. Now, here's what you got to pay attention to, though. In 2025, unless they change the law, that goes back down to 5 million indexed for inflation. So today it's about 575, I think. $5,750,000. Okay? I don't know, it may be $5,075,000. I think that's what it is. But anyway, it goes back down to 5 million. Now, you're thinking, well, gee whiz, that's still a lot more money than I got. But remember, if you live another 20 years and we have a current inflation rate, think about what the cost of property was in 1970 versus what it is now, and think what it will be in 2035. So you're going to have to watch that, and if you get close to that $5 million number, I need you to come in and talk to me or someone like me, because the first tax rate you hit once you break through that unified credit amount is 40 cents on every dollar. Okay, so it gets expensive fast once you hit it. Okay. Now then, in the last 2 or 3 years, the legislature has added this concept. By the way, I want to say one more thing about the unified credit. So think of the unified credit as a checking account with the federal government. And you can use that money to pay 2 things. You can use it to pay estate tax, or you can use it to pay gift tax. Okay? Because it's a unified credit. Okay. Now then, this thing called portability. Portability is a new concept in the law that was enacted, and what it does is it allows you to stack or to retain the unused portion of your deceased spouse's unified credit, provided you make certain filings up front. Okay? So my spouse dies, I file a gift tax return, I preserve that person's unified credit under the concept of portability, because there wasn't any estate tax on their estate because it was my spouse and I inherited everything via the unlimited marital deduction, right? So I've got all this unused unified credit on the part of my dead spouse. So I file a 706, I preserve her unified credit, and now at my death, I can pass 12.92 million times 2. So almost 26 million. Now, nothing would tickle my son more than if that was a concern I had, but it's not. So, portability allows you to use the unused unified credit of your spouse who has predeceased you. But you must make filings up front at that spouse's passing to preserve that credit. Okay? We used to use this to preserve or to stack the unified credits of a married couple. And that's why they went ahead and did the concept of portability, really, because we figured out a way around it anyway, so they might as well just let us have it, right? But the reason why we retained this slide up here is because this is a good example of what you do for second marriages late in life. Now, first of all, you know the 3 rules of real estate are location, location, location. And the 3 rules of second marriages late in life, prenup, prenup, prenup. Okay, so this is something you could use in that second marriage, because here we have a scenario, and we would probably make these mirror to each other, but let's pick on the husband. He's got this assets in his revocable trust. This is his second wife. He dies. All of his assets go into an irrevocable credit shelter trust. It pays the income to his surviving spouse. If he's written it in there, she can evade the principal. We can let her be the trustee, or we can let his kids of the first marriage be the gatekeeper, whatever we feel like is necessary. But at the end of the day, at his passing, his second spouse will get the benefit of his assets, and because it's an irrevocable trust, he knows that at that second spouse's death, those assets will go to the children of the first marriage. Okay? So that's one example of how you can provide for a second spouse late in life and still make sure you get the money, or your kids get the money, rather. Okay. Estate tax is a tax on property we pay after you die. Gift tax, remember, is a tax on property you give away while you're alive. There are 3 times whenever you can give something away and it not be subject to gift tax. Number 1 is a gift of tuition paid directly to the school, not to the kid, to give to the school, or medical expenses paid directly to a hospital, or a gift of something that has a value of less than $16,000 per person per year. That's called your gift tax exclusion. That number adjusts with inflation, by the way. Okay, now what's this mean? That means that I could give my son $16,000 not paying a gift tax. My son and my wife, or my wife and I, if I had one, could give him $32,000. See how that doubles? So it's a recipient-based exclusion. It's not a donor. I don't get one $16,000 per year. Everybody I give money to, I can go up to $16,000 on. Okay? So it's one of the rare recipient-based exclusions in the tax code. It's a unified credit. What happens if I go over $16,000? Well, then I got to pay gift tax, right? Well, let's say that I give away $1,016,000 to my son. I got to pay gift tax. So I file my gift tax return. I take off the $16,000 because I can do that under the gift tax exclusion. So now I got to pay gift tax on $1 million. I use part of my unified credit. I don't come out of my pocket with any money at all. The problem is, though, at my death, when everybody else can pass, what was it, 12.9 million, I can only pass 11.9 because I've already used $1 million on that previous gift. Is everybody in the boat on that? You can use the unified credit to pay either one, but it doesn't replenish. If I give away $12,900,000 while I'm alive, I don't have to come out of my pocket with any money, but then at my death, the very first dollar I have is going to be taxed for estate tax because I've already used up my unified credit. Okay, probably too much. Okay, Oklahoma does not have a gift tax, by the way. Now we're going to switch over to trust. 10 minutes left? Holy mackerel, I'm way behind this time, aren't I? Okay, guys, we're going to have to go faster. A trust has 4 parts. It has a settlor, a trustee, a beneficiary, and a fiduciary duty. I have longer than 10 minutes, though, because we started late.
That's fair. I think that's fair.
Settlor, a trust maker, or grantors, all different names for the same thing. Those are the people that sets up the trust. The trustee manages the trust property. Technically speaking, he's the beneficial owner of the title, or the legal owner of the title. And the trustee is the person who gets the use and, the beneficiary gets the use and enjoyment of the property. Okay, they have the beneficial title. So the trustee controls it, but the beneficiary gets the goodie. Right? So if you have your choice of being a settlor, a trustee, or a beneficiary, which one do you want to be? Beneficiary, that's right. Because they get the goodie. They get the popsicle. trusts fall into two categories. They're either revocable or they're irrevocable. Okay? And so, whether they call it a living trust, a loving trust, an inter vivos trust, those are just different names for the same thing. What you want to know is this a revocable trust? Because if it's a revocable trust, you can set it up on Monday, you can change the terms on Wednesday, you can do away with it on Friday if you don't like it. An irrevocable trust is pretty much set in stone once you sign on the dotted line. A revocable trust is tax neutral. You don't pay any more or less income taxes because you have a revocable trust. You don't pay any more or any less estate taxes if all you have is a simple revocable trust. Okay? A revocable trust does not protect your assets from a nursing home claim. Common misconception. A revocable trust does not protect you from a nursing home claim because and it doesn't protect you from creditors because you can reach in and grab those assets at any time. The IRS basically considers it a transparent item. Okay? Okay. So, an irrevocable trust, on the other hand, if it's set in stone, why would I ever want to use that? Well, because there are sometimes whenever you want the terms to be fixed in stone. For example, most revocable trusts I set up for clients become irrevocable at their death, so nobody can change the terms after they die. Get it? Okay? There are also income tax reasons to use irrevocable trusts sometimes. There are estate tax reasons to use irrevocable trusts sometimes, like the ownership of life insurance policies on very large estates. And if you have an intangible cost in your estate, we might set up an irrevocable trust that goes into effect at your death or after your death to take care of that intangible problem we're trying to solve. So irrevocable trusts have a use. Just make darn sure you know what it says and why you're doing it before you sign on the dotted line, because it's pretty much set in stone. Okay? Now, a test, and by the way, we have this toolbox of tools we use, and most of the time you won't need all these, but these are some of the things that are available to you at your estate plan. So we have this revocable trust, irrevocable trust. Testamentary trust is just a trust set up by your will. Now, I don't think I said this a while ago, but a will has no force and effect unless and until it's admitted to probate. So a will does not avoid probate. A will cannot set up that testamentary trust unless and until it's admitted to probate. Okay? So I have people come in and say, oh, I have a trust. Well, they have a testamentary trust inside their will, but we can't affect that trust until we admit that will to probate. Okay, so a will has no force and effect unless and until it's admitted to probate. That's the point I want you to leave here with. B-Trust, that revocable trust and B-Trust laws, we just saw an example of that on that screen. Family limited partnerships we used in succession planning. We use them for asset protection and that sort of thing. A family limited partnership we don't use anymore. We used to use those quite a bit, but of course bad facts make bad law, and somebody in California did something absolutely horrendous as part of their family limited partnership, and so the judge pierced that entity and put a charging order on those limited partnerships, which is the very thing we're trying to avoid, so we can't use them anymore because they've been blown up. But we can use LLCs, we can use corporations, and I think they're better anyway. Okay. Let's talk briefly. We're just going to skip incapacity, I think, because we're running out of time. But basically, the point I want to make to you is that there are two types of durable power of attorneys. There are immediate and springing. An immediate gives someone the immediate right to act on your estate. A springing power, it must be off. A doctor must determine that you're incapable of making decisions. A springing power is safer for you than an immediate because it requires a doctor's opinion before they have any power. With an immediate, they can run out, empty your bank account, go to Bali, and you cannot hold that bank responsible for that. Okay? Now then, but you have to jump through that hoop of getting that doctor's note that you're incapacitated before that springing durable power will work. And that's a real pain in the rear to get a doctor to say that. So if you really trust that person, an immediate durable power of attorney is fine, but you must trust that person emphatically. Okay? Because they have the power to clean out your bank accounts. I typically do springing ones on younger couples. If you came in though and you were like 85, somewhat dependent upon your children anyway to help you with your business, I'd do an immediate one and wouldn't think twice about it. Okay? So there's nothing technically wrong with having an immediate durable power of attorney. Just understand that you've empowered someone to act on your estate. Already more than I planned to say. Okay, state advance directive for healthcare. Just real briefly, you can elect to have the machines only taken off. You can elect to have the machines and stop feeding you through your veins, or you can tell them to leave everything on. 2 doctors must certify you as having that condition, and they must also get the approval of your healthcare proxy, which is typically a family member you've appointed, before they can take the action you've authorized. Okay? So, how do you want those things handled in your life? Think of it as having a room, okay? And when you authorize them to take the machines off there, keeping you alive, you've created a door that they can walk through, but they don't have to walk through. Because maybe your healthcare proxy thinks, you know, I don't know that is terminal. Let's keep her alive a little longer. Okay? So understand that you're creating doors that they can walk through. They don't have to walk through. But if you don't create the door, they can't go through it. So if you say that I want to be kept alive for as long as possible, then they cannot take your machines off. Follow me? Okay. Asset protection, our main problem is protection from lawsuits and then protection from nursing homes. The trick with using LLCs for asset protection is to house certain risky enterprises inside those different limited liability companies or LLCs. And that way, typically, you contain the damage in that LLC. So if I own 20 rent houses, I'd maybe do 5 LLCs, and I'd put 4 houses in each LLC, and that way if some dumb plumber did something stupid in one house that caused an injury, the people that were damaged could only get the assets in that one LLC. Well, why wouldn't you do an LLC for every house then? Because you got to do it. You got to do a tax accounting for every one of them, right? So at some point, the administrative burden has to be weighed against the asset protection. That's all I'm saying. Yes, the best way to do it is have each individual asset in its own LLC, but it would cost you a fortune to do your income tax return every year. Okay. Another good thing is to make sure you have an umbrella liability policy on your homeowner's insurance. That's an easy way to pick up some liability protection, okay? And then lastly, this is an important point. Limited liability company, we typically use that for succession planning to the next generation, okay? So it's just like a corporation kind of, except it has less requirements. And we can use those, like we can put the farm in an LLC, we can let the farming child rent the farm, then he pays rent to the LLC, then the LLC splits the money up between the other siblings. There's one example of where we use it, okay? Okay, now I want you to star this slide in your materials, please, because this is so misconstrued. A corporation or LLC does not protect you from personal liability if your personal actions contribute to the event that causes the injury. Now you see these ads, avoid liability, set up a corporation. Well, that is just pure crap. It will not protect you if you're the person that gave rise to the problem. So if you are the only employee of your company, I don't see where a corporation does you any good. Because anything you do, you've done personally, and so you're still going to be personally liable for it. A corporation or LLC protects you from the liability exposure that your employees expose you to, or that your non-personal events expose you to. What am I talking about? Guy walks across your farm, falls off a cliff, okay? You don't have any personal liability in that, okay? Guy walks across your farm, you're making dynamite, and you don't have a fence to keep him out, and he gets hurt, then you're liable. So there's different degrees of it, right? But for the most part, an LLC will protect you from the liability exposure caused by your employees. That's what you want to remember. On a typical farming operation, if it was a big time deal where they did a lot of trucking, we put all the rolling stock in one LLC, we put the farming operation in another one, and we put the land in its own LLC, because the land is the least likely to give rise to liability. So we put our danger assets together, we put our safe assets together, and we create these firewalls. Okay. Long-term care, basically your choices are to do nothing, spend private funds, have long-term care insurance, or arrange your assets to qualify for Medicaid assistance. Estate planning isn't, well, I guess we ought to talk about Medicaid. We're out of time though, right?
We're over about 2 minutes.
Okay. Let me talk just briefly about Medicaid then. We're going to come back to this. 'Cause I know you're just really excited to hear this. Let's see. Don't get there. Just need to be patient. Be patient, Michael. To qualify for state nursing home assistance, you must pass 3 tests. You must pass a medical test, which everybody passes because nobody wants to go to a nursing home. You must pass an income test, and you must pass an asset test, okay? The income test for a single person is $2,700 a month. You can't make more than that to qualify. You can make up to $5,700 a month if you use a Medicaid income trust, okay? As far as we're going to go there, but just know that you can have income up to $5,700 and still qualify under the income test. But you still must have non-exempt assets of less than $2,000. Now, you can have a prepaid burial plan. You can have a car that takes you to the doctor 4 times a year. You can have, I don't know, 10 chickens, 2 goats, a gun, family Bibles, some stuff like that. But that's about it. Okay. Now, so you basically got to be a pauper to qualify for nursing home assistance as an individual. If you're a married couple, what happened was the government saw that the community spouse, typically the woman, that's the one staying at the home, would expend all of their resources trying to support their husband who was in the institution. Then he dies, and now then the government's left with a widow who doesn't have any money. Can't take care of him or herself, right? Well, that isn't any good. So they passed the Spousal Impoverishment Act. And what it says is basically that if you put your spouse in a nursing home, you're allowed to keep a portion of your assets and still qualify them for state assistance. Now, it gets pretty complicated on what that qualification is, but generally speaking, if that community spouse, the one staying at home, has income of less than $3,700, they can transfer up to that much income from the institutionalized spouse to them to use. Okay? You got to spend half your assets down, but that half does not need to be less than $29,000, nor can it be more than $148,000. So if a married couple wants to put the husband in a nursing home and they have an estate of $100,000 of countable assets, they'd have to spend down to $50,000. If they had an estate of $30,000, they'd have to spend down about $300. Okay? If they have an estate of $2 million, they got to spend down to $148,000. See how that works? Half, but the half cannot be less than this much, nor can it be more than that much. Okay. If you give stuff away, you can create a period of ineligibility. So you can't just give away your assets